If you're looking for an awesome product at a great price, be sure to check out the link in the description. Diageo, the world's leading spirits producer and home to iconic brands like Guinness, Johnnie Walker, and Smirnoff, has announced a significant downturn in annual profits, sending ripples through the financial markets. The news comes amidst a period of considerable upheaval for the FTSE 100 company, marked by the surprise resignation of CEO Deborah Crew and the launch of an extensive cost-cutting initiative. The company's operating profit plummeted by nearly 28% in the fiscal year ending June 2024, a stark contrast to the previous year's performance. This substantial decline prompted Diageo to increase its cost-saving target from £500 million to a more ambitious £625 million. While interim CEO Nick Jangiani assures the public that this streamlining isn't solely focused on job cuts, the restructuring inevitably involves workforce adjustments. The search for a permanent replacement for Crew, whose departure was announced as a mutual agreement following investor concerns about declining share prices, is currently underway. Adding to the financial pressures, Diageo anticipates a substantial $200 million annual impact from the tariffs imposed by the Trump administration. This projection, initially made in February, assumes no further changes to import tariffs into the United States. The 10% levy on UK spirits and a 15% tax on EU spirits remain in effect, while Mexican and Canadian spirits enjoy exemption. The implementation of tariffs on British goods began on June 30, coinciding with the UK-US trade deal's commencement, while the 15% levy on EU goods is set to take effect on August 7. Diageo asserts its proactive approach to mitigating this financial burden, implementing extensive contingency planning, including shrewd inventory management, supply chain optimization, and strategic reallocation of investments. Through these measures, the company projects it can offset approximately half of the tariff's impact on operating profit. Crew's tenure, which began in 2023 following the untimely passing of Ivan Menezes, was marked by challenges. An earlier profit warning resulted from a sales slump in Latin America and the Caribbean, and criticisms arose concerning supply chain management over the last Christmas season, with reports of Guinness shortages impacting UK pubs. Now, Jangiani, taking the helm as interim CEO, faces the daunting task of navigating these turbulent waters, along with the simultaneous search for both a new CEO and CFO. Despite the overall financial downturn, Jangiani highlighted the strong performance of certain brands, including Guinness, Don Julio Tequila, and Crown Royal Blackberry, underscoring the potential for future growth within the Diageo portfolio. However, he acknowledged the need for further strategic improvements across the wider brand spectrum. The market reflects the company's struggles, with Diageo's share price declining over 25% this year. This performance ranks it among the FTSE 100's 3 worst-performing stocks, according to AJ Bell analysis, a level not seen since 2016. This downturn isn't solely attributable to tariffs, evolving consumer drinking habits, particularly amongst younger demographics, and the cost of living crisis, which is prompting consumers to opt for cheaper alternatives, are also significant contributing factors. The future of Diageo, a company steeped in history and synonymous with globally recognized brands, now hangs in the balance, as it navigates these complex challenges and searches for new leadership to steer it towards renewed profitability and stability in a rapidly changing market landscape. The uncertainty surrounding the future leadership, coupled with the lingering effects of tariffs and shifting consumer preferences, presents a complex and demanding scenario for Diageo's stakeholders and investors alike. The coming months will be crucial in determining the company's trajectory and its ability to regain its position as a market leader in the global spirits industry. The weight of expectation rests heavily on the shoulders of the incoming leadership team to formulate a robust strategy that can address these challenges head-on and revitalize Diageo's financial performance. The long-term outlook remains uncertain, but the immediate future will be defined by the company's ability to adapt to changing market dynamics, manage its costs effectively, and maintain its brand equity amidst economic headwinds. The saga of Diageo's recent struggles serves as a potent reminder of the volatility inherent in the global beverage industry and the multifaceted factors that can influence even the most established of companies. The world watches as Diageo charts its course through this period of uncertainty, hoping for a return to the strong financial performance that has defined its history. The implications extend beyond Diageo itself, affecting investors, employees, and the wider beverage industry as a whole. This complex situation warrants close monitoring, as its resolution will have significant ramifications